Welcome back to OneMoreStock channel, and welcome back to the deep dive. Today, we are jumping into a company that really sits at the bleeding edge of finance and technology. We're talking about Upstart Holdings, Inc. ticker UPST.
It's great to be here.
Yeah.
This is a deep dive you, our listener, specifically asked for, and I can see why. Upstart is, well, it's arguably the most interesting and, volatile AI lending platform out there.
That volatility really tells a story, and our mission today is to cut right through that noise. We're using a fantastic comprehensive analysis from the One More Money blog, and it frames UPST as this massive high-stakes bet.
A bet on what exactly?
A bet on whether sophisticated AI can finally truly replace the old rigid FICO score.
Exactly. And we've seen this incredible performance, right? A rally that's been called a U-shaped reversal, but then it's followed by these huge pullbacks. The tech promise is, it's obvious.
What's the real question?
The real question is structural. Can Upstart's business model, which is pretty unique, can it actually withstand the cycles? Credit tightening, rising interest rates, all that.
That really is the crux of it. So let's unpack this. We'll start with their asset-light model, how they make money. Then we'll dive into the tech itself, its power, and maybe its limitations.
And then the reality check.
Yeah.
The Q3 2025 financials.
Right. And after that, we have to spend some real time on the big structural risks, because that's what will likely determine where this company goes long term.
Okay, let's start at square one. What is Upstart and, why are they even in this market?
Well, Upstart Holdings is trying to solve a pretty fundamental problem: access to credit. They basically argue that the old models, like FICO, they just leave too many credit-worthy people behind. So their mission is to use AI to get a much more accurate picture of risk.
Which is better for everyone, in theory.
In theory, yes. The borrower gets a better rate and the bank gets lower defaults. It's a win-win.
And the key detail here, the one that I think a lot of people miss, is that Upstart itself is not a bank. Correct. And this is absolutely crucial to understand. They are an AI loan intermediary. They don't have a banking license. They don't hold your deposits.
And that lack of deposits, it's a double-edged sword.
It is. It was their original advantage, but as we'll get into, it's also their biggest vulnerability.
So walk us through how that platform actually works. A borrower comes to them. What happens next?
It's a classic platform model. You apply on Upstart's site. Their AI engine crunches the numbers instantly, assessing your risk. If you're approved, Upstart becomes a matchmaker. It connects you to one of its partners, over 100 banks and credit unions.
And the partner is the one who actually funds the loan.
Precisely. The partner funds it, they hold the risk, and Upstart just takes a fee for the service, for the origination.
That's the asset-light model. It let them scale like crazy at first, right? Because they didn't need huge amounts of capital sitting on a balance sheet.
Exactly.
So if they aren't the lender, how do they make their money? Where's the revenue coming from?
It's almost all based on volume. Just getting loans through the system. Historically, the lion's share, something like 79%, comes from platform and referral fees. The banks lay them for two things: using their AI for underwriting and for getting a steady stream of qualified borrowers.
So they're basically a high-tech filter, and they get paid for how accurate that filter is.
That's a great way to put it. The rest of their revenue is split between servicing fees, that's around 12%, and then a really small piece less than 10% from net interest income.
And that's from the loans they hold themselves.
Right, from a tiny portfolio they keep on their books, mostly for R&D, just to keep training the AI. But their success, really, it all hinges on originating a high volume of quality loans for their partners.
Okay, let's get under the hood. The whole value proposition here is the AI. The analysis points out it looks at over 2,500 variables. I mean, that just absolutely dwarfs a FICO score.
And that's their central advantage. The sheer scale of the data they've trained on, tens of millions of data points, is what lets the model see things that FICO can't. They're finding people with, maybe a low traditional score who are actually a great credit risk. They're expanding the pie for their bank partners.
The efficiency numbers are just wild. The analysis said 91 to 92% of recent loan approvals were totally automated.
Yes, that speed, that lack of human friction, it creates this massive cost efficiency. It drives down the cost per loan.
And the tech isn't just sitting still.
Not at all. They're constantly iterating. The One More Money blog brought up their Model 22 architecture. They call it AI for the AI.
AI for the AI. What does that even mean?
It's like a meta layer, a layer of neural networks that's constantly watching the underlying models, evaluating their performance, and making them smarter. It's about improving judgment, not just crunching numbers.
That's incredibly sophisticated. So strategically, how does that tech advantage translate into growth?
Well, beyond just being cheaper and faster, they're using it to push into much bigger markets. They're moving aggressively past just personal loans and into huge categories like auto loans, and this is a big one, home equity lines of credit, HELZs.
That really blows up their total addressable market.
Massively.
Okay, let's talk about the moat, because this is where the skeptical investor in me starts asking questions. A data-driven moat sounds great. More data, better AI, more loans.
It's a feedback loop, yes.
But the analysis says this moat might have some serious holes in it.
It does. Look, the feedback loop is real and it's valuable, but it's not some impenetrable fortress. You have to remember who they're working with. The big banks aren't just sitting around. They have decades of their own proprietary data on millions of customers. They can and they are building their own AI models in-house.
So a giant like JP Morgan could just decide to build their own Upstart and cut them out completely.
That is the tension. Upstart's edge is the platform and how fast they iterate, but then you have competitors like SoFi who are building a totally different kind of moat.
An integrated one.
Exactly. Deposits, investments, mortgages, loans. They see the whole customer picture.
Yeah.
That integrated data, plus their stable deposit funding, might actually be a much stronger, more resilient moat than Upstart's specialized one.
All right, let's ground this in reality. The numbers. The One More Money blog pointed out that 2025 was a big turnaround year. Q2 even got back to GAAP profitability, which set expectations really high for Q3.
Absolutely. And, if you look at the Q3 results in a vacuum, they were strong, really strong. Total revenue hit $277 million. That's about 71% growth year over year. Loan origination volume was up 80%. Automation stayed high, around 91%. I mean, on paper, that is phenomenal.
So why did the market freak out? The stock got punished. It wasn't about the past quarter's success. It was about the future.
It was all about the guidance. It came down to one thing. The Q4 forecast. Management guided for Q4 revenue of about $288 million.
Which is still growth, technically. Technically. But that only represents about 32% year-over-year growth. And the market saw that cliff dive from 71% growth down to a forecast of 32% and saw a massive deceleration. That volatility is what triggered the concern.
And that deceleration just brings us right back to the structural risks we talked about. Before we go there, though, there was a little note about their balance sheet. They're holding a few more loans themselves now.
They are, especially in the newer areas like auto and HELACs. It's a tactical move. They say it's for R&D to season the models. But you could also call it a necessary evil. It introduces credit risk, right where the pure tech platform story says there shouldn't be any. It just shows how hard it is to be a pure tech player in a capital business.
Okay, let's really dig into these structural problems, because it feels like they can overshadow even the smartest AI. The analysis pegs capital market dependency as the #1 risk. It is the core fragility of the whole model. Upstart's platform is, it's kind of built on sand because it doesn't have stable funding from consumer deposits. They are 100% reliant on their partner banks and the capital markets.
And when those partners get nervous?
The faucet turns off.
Mm-hmm.
The analysis put it perfectly. The faucet is in someone else's house.
Mm.
When rates go up or the macro outlook gets gloomy, banks pull back. It's just what they do.
So no matter how good the AI is at finding credit-worthy borrowers, if the capital markets tighten up, Upstart's volume and 79% of their revenue just evaporate.
It falls off a cliff. They are a volume machine that is completely hostage to the mood of their partners.
And that leads right into what the analysis called the light asset paradox. I love that term.
It's a great name for the irony, isn't it? When that partner funding dries up, Upstart has this awful choice.
Watch their growth just sputter out.
Or step in themselves. Use their own balance sheet to hold the loans and keep the machine running.
But by doing that, they risk becoming what the analysis called a shadow bank.
Exactly. The second they take on significant credit risk, they've broken the clean, asset-light tech platform story that investors fell in love with. That changes how you value the company. It exposes them to credit risk, funding risk, and probably more regulatory risk down the line.
Wait, so the solution to their biggest problem, lack of funding, actually destroys the very reason the market gives them a high-tech valuation in the first place.
That is the trap. It feels like a fundamental flaw in the intermediary model, at least in finance.
Wow. Okay, and then there's the third conflict, the AI conundrum. This one is really counterintuitive.
It is. So the AI is designed to be smart, to be prudent, to manage risk well.
As it should be.
As it should be. But think about what happens if the economy gets worse, if consumer credit starts to weaken. The AI, being prudent, will naturally tighten its standards. It will approve fewer loans. It will raise the bar. And while that is great risk management,
It kills their volume.
kills their volume, which kills their revenue.
So the AI doing its job properly actually works against the company's main goal of high growth. It's a growth stock that is structurally designed to hit the brakes during economic stress. That explains everything about the market's reaction to that Q4 guidance.
That's precisely why it's so volatile. Investors see this engine that needs volume to run, but the engine itself has a built-in brake that it applies whenever the road gets bumpy.
And let's not forget the competition. We mentioned SoFi, but the banks are still there. Disintermediation is a real
Well,
threat.
it's a huge threat. The integrated players like SoFi have the funding advantage with deposits. And if a big bank decides that building their own AI is cheaper in the long run than paying Upstart's fee,
Which they can absolutely afford to do.
they can. And if that happens, then the core of Upstart's business is at risk. Their whole defense is just to keep innovating on tech faster than the banks can possibly keep up.
So looking ahead, what are the levers they can pull? How can they fight back against these structural issues?
The focus has to be on scaling those new bigger verticals. Auto loans, HLOCs. The Q3 numbers did show some encouraging green shoots there, which validates the strategy. They also have to just keep expanding that partner network, get way beyond 100 institutions, and of course, relentlessly improve the tech to stay ahead.
And for us, for the listener, what are the big external things to watch?
I'd say watch two things. First, interest rates. A lower rate environment is a massive tailwind for them. It just juices demand and makes partners more willing to lend. Second, watch consumer credit health. Upstart has its own index for this, the UMI. If you see that UMI flashing red, you know the AI is about to start tightening, and that means volume is going to slow down.
Okay, so if we pull this all together, Upstart is a pure high-risk, high-reward bet. The Q3 results showed the AI is smart, it works. But the stock's future, it seems, has almost nothing to do with the AI and everything to do with the resilience of the business model.
It's about whether a pure tech intermediary can actually survive the cycles, better than an old-school, structurally sound bank.
So what's the final thought, the provocative idea for us to chew on?
I think UPST's entire journey is a litmus test for the whole fintech space. It's the ultimate question of whether a platform with incredible technology and speed can really win against traditional institutions that have that boring but critical structural funding advantage. This is a thesis with truly binary upside. Execution and the macro environment are going to decide if it's a huge success or a spectacular failure. It really is a high-stakes bet on the future of how finance is structured.
A comprehensive look at the promise and the real peril of Upstart Holdings. And now we have to briefly include the required disclaimer content from the One More Money blog. This article is for educational purposes only and does not constitute investment advice. Investors should conduct their own due diligence before making any decisions. Thank you for watching. We have such great appreciation for you engaging with this deep dive. If you're interested in U.S. stock investment and you want more detailed analysis just like this, please subscribe to the OneMoreStock channel, like this video, and definitely comment below. Let us know what you think about this topic. We love hearing from you, and we want to make sure you don't miss any of our latest analysis in the future. See you again in the next stock analysis. Goodbye.